Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guests today are two Invesco strategists who support the ultra-popular QQQ ETF, or the Qs, and RSP, the equal-weighted S&P 500 ETF, which has seen a lot of interest from investors lately because we know that earlier this year, market gains were driven entirely by the magnificent seven stocks: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. But lately, we have seen these giants struggle a bit, and a wider group of the market is outperforming the giants. And the seven stocks now dominate the market cap weighted indexes. So many investors have been worried about over concentration of these indexes. And with equal weighting, investors get more exposure to old economy sectors and also value stocks. Now, we cannot predict whether mega cap growth stocks will continue to do well later this year or pass on the baton to smaller value stocks. And in fact, we do not make any investment recommendations on this show, but we have the perfect guests to help you learn more and decide where to put your money to work now. So let's bring in our guests without further ado. Joining me now are Paul Schroeder, QQQ Equity ETF Strategist, and Chris Dallin, Factor and Core Equity Strategist at Invesco. Paul and Chris, welcome to both of you, and thanks for joining us today.
Thanks for having us, Neena.
Yeah, it's great to be here. Appreciate it.
So I wanted to start with you, Paul, and talk about QQQ, which is one of the most popular ETFs in the world, and it is also one of the best performing ETFs ever. So this is like a superstar ETF. So we know that Qs, it was up almost 40% in the first half. So tell us a little bit about factors that drove QQQ's outperformance in the first half.
Sure, and I appreciate the question, Neena. So, as you alluded to, QQQ had a fantastic first half of the year, up 39% through the end of June. And from a sector perspective, really the Q's exposure, overweight exposure, I should say, to IT, consumer discretionary, and communication services, while also being underweight healthcare and financials were really the primary drivers of its performance. But if we dive deeper into what was happening in the market, there are, I think, really three reasons why Qs performed so well. First, we saw a little bit of mean reversion. If we think back, obviously 2022 introduced higher volatility that we saw during COVID, but really before that, we haven't seen that level of volatility since the global financial crisis. And, much of it was really caused by the aggressive rate hiking cycle that the Fed enacted, where, the Fed funds rate reached levels not seen since 2007. This caused many large cap growth companies to underperform the broader market. Just to name a few, we saw Tesla and Meta down nearly 65%, Amazon, Nvidia, Netflix down around 50%, and Apple down 26%. But as we moved into 2023, we saw the narrative start to really change. Inflation seemed to peak, and we saw spending from consumers remained resilient and unemployment remained low, despite the higher Fed funds rate. The trade that worked well in 2022 really didn't work in the first quarter of 2023, as we saw energy prices fall and financials obviously pull back due to a new financial crisis within the banking system. This really caused investors to move back into the names, which are some of the largest holdings within QQQ. Nvidia being the rock star that it was so far this year was up nearly 190%. Meta also up triple digits along with Tesla. Apple became the first $3 trillion market cap company in the world in history. And NVIDIA became the fifth $1 trillion company in the world as well. So I think we saw part of the performance can be attributed to that pendulum swinging back from the poor performance that we saw in 2022. The second part, I think, that can go without saying has been this craze around artificial intelligence. Really, as I said, we saw this reversion in Q1, and then Q2, the AI craze really took hold of investors with the popularity of ChatGPT really rising, generative AI becoming really mainstream, and the term AI being one of the most mentioned terms in headlines for the first half of the year. And really that comes off the potential of the productivity increase that AI can introduce into the overall market, not just within generative AI, but other parts as well. NVIDIA was obviously a primary benefactor of that craze. And really, we see AI being a primary component within semiconductors, within that specific industry. Their hardware, along with other computer chips that they manufacture, really being needed to power a lot of these AI applications. And obviously, there were several other companies within QQQ that were benefactors of AI. The third I would say would be the overall macroeconomic factors that caused really QQQ to be viewed as almost a safety trade, similar to what we saw in the second half of 2020. We saw many investors move back into the names that were top 10 holdings within the Qs, and as we moved into late spring, the banking crisis that popped up obviously helped those names as well.
And that was a great summary of the factors that drove its performance in the first half. So, as you mentioned at the start of this year, these companies, the mega cap giants, looked very attractively priced after last year's sell-off. So, from valuation perspective, the setup looks a bit negative for these stocks. But at the same time, these are highly profitable companies, have a lot of cash on their balance sheets, and these are also some of the best run companies in the world. So now looking at the rest of the year, if the economy falls into a recession or if the economy slows down, which is what most experts believe, then these companies may continue to do well. But from the valuation perspective, these don't look very attractive now. So what do you expect in terms of performance for the rest of this year? What will drive the performance in the rest of 2023?
Sure. So overall, I think the macroeconomic factors that you mentioned are really going to be extremely important as we move into the second half. Specifically, as you alluded to, there's potential for a recession or at least a slowing of the economy, along with interest rates rising. I think these two factors are probably going to be the main focus for investors. Luckily so far though, we've received positive news on both of those fronts. Unemployment has remained near all-time lows. We've also seen a recent GDP number where GDP is still growing higher than I think what a lot of investors and analysts expected. Really, I think the question remains as to what the Fed is going to do. Right after the previous FOMC meeting, it seemed the market was really pricing in that the Fed might have stopped hiking rates for this cycle. As the previous few weeks have progressed, though, the likelihood of a Fed rate hike has started to move up. Still, around 40% chance of a 25 basis point rate hike at the next meeting. But we'll have to see how that all plays out. I think the second most important factor is going to be will some of these AI companies, AI focus and AI adjacent companies be able to deliver on the guidance that they really provided after Q1. NVIDIA raised guidance for revenue by nearly 50%, which if they hit that number here, where they're announcing here in the next week or so, will be really a record-breaking number for their company. So again, I hate to circle back to AI, but since AI has driven a lot of the performance that we've seen over the past few months, where a lot of these earnings that people thought were maybe a year, 2 years out are being pulled forward here to perhaps the next few quarters. I think we really need to see some of these companies deliver on some of the revenue guidance that they've provided.
As I mentioned earlier, QQQ or the Qs, it is also one of the best performing ETFs over the past 15 years or so. So could you talk a little bit about its historical performance?
So we've seen fantastic performance from the Qs, over the past 10, 15 years. Using 15 years as a gauge, it's up over 830% cumulatively, which equates to about a 16% annualized return that far exceeds the return of the broader market, where if we take a look at the S&P 500 during that same time frame, cumulatively it's up about 370%, or up around 11% annualized. And we've seen investors really gravitate towards the Qs to be the growth engine of their portfolio, really since it's been around its inception in 1999. What has really fueled that growth throughout the years is the question, and we really truly believe it's the fundamental growth within the companies inside of the Qs that has fueled that. And really, it's the innovative nature of the companies within the Qs, their ability to pivot and remain nimble and diversify their business lines, which has driven that fundamental growth really through decades. If we were to quantify that in a certain way, we've seen growth of revenue, earnings, and dividends of the Qs outpace that of the S&P 500. The growth rate of revenue within the Qs is double that of the S&P 500 when you look at revenue, and it's 50% higher when you look at revenue. And lastly, what I would say is that the dividend growth is about 40%, 46% higher than that of the S&P 500, and that's on a compounded annual growth rate perspective. So really, we've seen fundamental growth of the companies, driven by the innovative nature of these companies, really drive the performance of the Qs.
Very impressive performance for sure. Now, one of the main concerns for investors is valuations now, and as we discussed a little bit earlier, but as you mentioned, that many of these companies are raising their guidance. For example, NVIDIA's revenue guidance went up a lot because these companies are making a lot more money. These are profit machines. So because of that, earnings expectations have also gone up over the past few years, and this year in particular. So I wanted to talk a little bit more about valuations, and compared to historical valuations, does the index look too expensive now, or is it more reasonably priced?
I think that's a very reasonable and actually common question that we get on the Qs. If we use a common valuation metric, let's say like price to earnings, since 2005, we've seen the Qs PE in a range of about 20 to 30. Today, it's sitting around 31. So we're right at the top end of, I'd say, that normalized range that we've seen really over the last almost 20 years. To give you some reference, in 2021, when the market peaked, we saw PE get above 40, which, we definitely thought was a little hot. And then in the lows in 2022, we saw it drop down to the low 20s. So I'd say we're right at the top of that normalized range where we are right now. But I think more importantly, if we look at the Qs specifically, PE hasn't necessarily been the most reliable predictor of future returns for the Qs specifically. If we take a look over that same time frame from 2005 to today, we've seen the PE rise by about 4%, whereas the Qs have returned over 950% cumulatively during that time. So again, we feel it's more of the fundamental growth story that really has fueled the performance that we've seen thus far versus the valuations that we're seeing.
That's quite helpful. Now, you alluded to innovation by these companies, and in fact, both QQQ and its cheaper version, QQQM, are a part of what Invesco calls the innovation suite. And it's because the company Invesco says that these companies have established a culture of innovation and their commitment to R&D. So could you talk a little bit about R&D spending by QQQ constituents?
As you just said, QQQ is filled with some of the most innovative companies in the world. The term innovation is one of the more common and regularly used term, I think, over the past three years. But unless you're able to really quantify innovation, the term is really aspirational more than anything. So we use R&D as one of the primary gauges of how innovative a company is. Specifically with R&D, it's a company investing in its own future, because you typically don't see R&D add to revenue or earnings within the next few quarters once that spend comes on, or even years. So what we've seen is that the average QQQ company is outspending your average S&P 500 company on research and development by about 2x. In 2022, we saw research and development spend come in at about $18 billion on average per company within QQQ. I think what's really interesting is that if you take a look at the S&P 500's spend, the average company within, it's about $9.1 billion. But if you take out those companies that are also included in QQQ, that number drops down to about $1.2 billion. So it drops quite a bit. And I think it just really illustrates that QQQ companies are very focused on being innovative by spending more on research and development, and really investing in their future.
Excellent. So this index underwent a special rebalance last month. Could you please tell us what exactly happened, what investors should know about that rebalance?
Sure. So the special rebalance was talked about quite a bit during the month of July. And just for everyone's reference, this was the third special rebalance that QQQ's underlying index, the NASDAQ 100, had seen. The first was back in 1998, and the second was in 2011. And this rebalance was triggered by the NASDAQ 100's index methodology, specifically the portion that is driven by the Regulated Investment Company Diversification Rules, or RIC rules for short. So in order for the index to remain compliant, it implemented a rule within the methodology that takes a look at the aggregate weights of any company that is weighted above 4.5%. So what the index does, it aggregates all those companies' weights, and if it's below 48%, there's no need to do a rebalance. Now keep in mind this rule of 48% is implemented at every quarterly rebalance that the NASDAQ 100 and the Qs goes through. It's just that on July 3rd, what we saw was that 48% threshold be breached, which triggered this rule. So NASDAQ announced on Friday, July 14th, that it would go through the special rebalance using July 3rd as the reference date, and it went effective on July 24th, which was a Monday before the market opened. So what were the results of the special rebalance? So what we saw were the 7 largest companies within the Qs, their weights were reduced. So we saw Apple, Microsoft, Amazon, Nvidia, Meta, Tesla, and Alphabet have their weights reduced. Now, specific to Alphabet, we hold both the Class A and Class C shares, so both of those were reduced. So we saw a total reduction between these 7 different companies drop by about 12% in total, and they were redistributed to the remaining 93 companies. From a sector perspective, technology saw the largest decrease of about 4.5%, and healthcare saw the largest increase, along with a few other sectors. Ultimately, what we saw from this special rebalance is that the index in QQQ now, I'd say, more accurately reflects the market capitalization of the overall index, where you have Apple being the largest company, Microsoft, and so on, all the way down to the 100th company, having the weights more proportionately reflective of where they sit from a market cap perspective.
So I have 2 follow-up questions on the rebalancing. What does the rebalancing mean for investors, and will there be any tax consequences in particular because of the selling and buying of these stocks? And also, you mentioned that this was the 3rd special rebalancing. So could you please tell us a little bit what happened during the 1998 and 2011 rebalancing?
To answer your first question, Nina, really what this means for investors is that QQQ now, the weights of each company within QQQ, I'd say now more clearly reflects the actual size and proportion of the 100 companies, 100 largest companies, ex financials that are listed on the NASDAQ Stock Exchange. What you saw prior to that is that some of these companies were getting rebalance during the quarterly rebalance because the 48% wasn't breached. At the rebalance, you saw Microsoft and Apple have the same weight, essentially at the December rebalance, where we all know that Apple is a much bigger company than Microsoft. You also saw different things happen, where as Nvidia had stellar performance throughout 2023, it started to move up in the rankings within the Qs, where it surpassed Google in some cases, and on some days where the market cap was smaller than Google. So I should say Alphabet, excuse me. So it more accurately reflects and ranks the companies, essentially giving investors, I think, what they expect from the Qs. To answer your second question, we're not necessarily tax professionals here at Invesco, so I can't speak directly as to what sort of tax consequences will result from the special rebalance. What I will say, though, is that the Qs go through quarterly rebalances on a regular cadence. It's part of the methodology of the index that it tracks. So you see annual turnover within the fund ranging between 6 to 9% on any given year. I would expect the turnover for this year to be on the higher range. One thing that I will say is that since 1999, the Qs has not paid out a capital gain to their shareholders. So I can't speak to whether there'll be one this year or not. We'll have to see. But because of the ETF structure that the Qs is in, it lends to a more tax efficient management of the overall fund. To answer your third question, going back to the first rebalance back in 1998, if you recall, Qs were incepted back in March of 1999. So NASDAQ ran this first special rebalance to make sure that they could launch a product and be compliant within the RIC diversification rules, which changed the index methodology from being a pure market cap weighted index to being a modified market cap weighted index. And it was needed in order to be able to commercialize the index into a product. The 2011 rebalance, special rebalance, happened because of a second rule within the index methodology, also pertaining to the RIC diversification rules, where a given company cannot exceed 24% of the overall weight within a given fund. So at that time, Apple was the largest, still the largest constituent within the fund. Its overall weight within the fund exceeded 24%, which caused a special rebalance.
Very interesting. Now, we alluded to QQQM a bit earlier. It is the cheaper version of QQQ. So could you talk a little bit about how these two ETFs should be used? Is QQQM more suitable for longer-term focused buy and hold investors, and QQQ is more suitable for traders?
Yeah, thanks for bringing up QQQM. It's a fund that we launched back in 2020 and tracks the exact same index as the Qs. So you're effectively getting the same exposure. It has a smaller expense ratio at 0.15% versus the Qs 0.20%. And really, we launched it for the exact reason that you mentioned, Nina. The Qs has always been used for many different things, including buy and hold investors. I couldn't tell you how many conversations that I've had with investors saying I've held the Qs for decades, and it's one of my favorite ETFs that I own. So I think both can be used for buy and hold, but with where we are today and where the ETF industry has evolved really since the 90s, is that investors are expecting a few different things. They're expecting obviously lower costs. Not that 20 basis points is unreasonable, but with certain ETFs out there that have expense ratios in single digits, any way that we could help out buy and hold investors, longer term investors, by lowering that expense ratio, we wanted to do. And it was much easier to do that by launching a new product versus trying to change the structure of the Qs. The second thing that investors expect is that with ETFs, most ETFs being index-based passive investments, they want their investment to track their index as tightly as possible. So the structure that QQQM was launched in allows our portfolio managers to reinvest the dividends received by the companies held within the fund, along with participating in securities lending to generate extra revenue. Those two things help QQQM track the NASDAQ 100 much closer, having a lower tracking error.
Excellent. Thank you again, Paul. And let's talk about the equal weighted ETFs now, particularly the Invesco S&P 500 equal weight ETF, ticker symbol RSP, which is the most popular equal weighted ETF. And in fact, it is the first smart beta or alternatively weighted ETF. It celebrated its 20th birthday recently, and since its debut in 2003, RSP has significantly outperformed the market cap weighted S&P 500 index. So Chris, tell us a little bit about RSP and its history.
Sure, Nina. Thanks for the question. And I'll assume many of your listeners are either aware of RSP or could figure out the methodology just from the name alone, because the Invesco S&P 500 equal weight ETF is probably about the most wholly descriptively named ETF in the market. But I would just note that RSP does equally weight all of the stocks in the S&P 500. So each quarterly rebalance, each of those positions receives an approximate 0.2% weighting at that time. And so what's happening in practice is, in between those quarterly rebalances, some stocks are obviously appreciating in value more than others. Their weight rises above that 0.2%. Other stocks lose value more than others. Their weight sinks below that initial 0.2%. But then once that quarterly rebalance comes back around, RSP is going to buy a little more of those underperforming positions. It's going to sell a little bit of those outperforming positions. And so this kind of creates a natural buy low, sell high mechanism. And so it kind of seems like a fairly simplistic weighting approach actually has some very useful properties. And if you and we do this here at Invesco, but if one were to go back and look and run the attribution of returns over that 20-year period that you referenced, Nina, that quarterly rebalance has actually been a significant contributor to RSP's returns since inception. And then the other thing I would say, one of the other natural byproducts of equal weighting, at least relative to capitalization weighting schemes, is that equal weighting will tend to tilt a portfolio towards two rewarded investment factors: the size factor, the small size factor, and the value factor. Now, RSP is not a value product. If you look at it, for example, in Morningstar Direct, it does style out large blend, but it tends to, maybe if you're looking at a style box, it tends to lean a little left of the blend box relative to a cap-weighted S&P 500. And so, while outperformance of those two factors can ebb and flow from year to year, we know that over longer periods of time, those factors have been shown to be rewarded exposures. And so to have those exposures is positive, it positively contributes to RSP's relative return. So, as you had mentioned, Nina, from a historical standpoint, in the spring, we celebrated RSP's 20th anniversary since its inception in April 2003. And it was fun to look back, and to kind of see what the ETF universe looked like back then. And, although there are over 3,000 domestically listed ETFs now, back when we launched RSP, there was only about 100 ETFs in existence domestically. And RSP, to your point, was a little unique because almost all of those ETFs in existence were market capitalization weighted. So RSP was kind of the first one to put to test this belief that, hey, maybe equal weighting and leaning into those rewarded investment factors I referenced and the quarterly rebalances of seeking to buy low and sell high, maybe that could make for a better core experience. And so it's nice to have now 20 years of actual live returns because, it gives us that good history to look back upon and analyze how that theory worked out over time. And so, as you had said, I looked at Bloomberg 2 days ago before this podcast. RSP, I think your math probably works about this, but RSP's outperformed the S&P 500 by about 75 percentage points since inception, which works out to about half a percentage point per annum. So we're really happy about that. And it's likely one of the reasons why investors have made RSP one of the largest ETFs and have entrusted it with over $43 billion in assets, Nina.
Very impressive historical performance. And as we discussed earlier, over concentration of cap-weighted indexes is one of the big concerns for investors now. And currently, the top 10 mega cap companies, they account for almost 35% of the S&P 500 cap-weighted index. And we keep reading that this is much higher compared to, historical figures, even higher than during the tech bubble. So could you tell us a little bit about how concentrated the S&P 500 index is compared to history?
Yeah, and it's a good question. It's one that has been coming up quite a bit with our investors. And, if you looked, that is a good way to look at concentration, right? Let's look at how much of any individual investment or individual index is in maybe the top 10 holdings. And if you were to look at the beginning of the year, you would have seen that the top 10 companies in the S&P 500 accounted for just under 26% of that total index. To your point, recently that percentage has jumped to a little under 35%, maybe 32, 33%. So we've kind of seen this 6 or 7 percentage point increase in those top 10 names. Now, that, to say that another way, there's 500 or so holdings in the S&P 500. Just 10 of those holdings is making up about a third of your total exposure. And to further put that into context, over the last 30 years, that number, so that the percentage of assets in the top 10 holdings in the S&P has averaged closer to about 21%. If you were to look maybe at periods before, let's call it the COVID era, where it's been a little bit elevated since COVID. If you were to go back, the last peak we saw in that percentage of assets in the top 10 holdings in the S&P was during the dot-com bubble. And during that time, the top 10 holdings kind of peaked at around 27% versus, that 32, 33% we're at right now. So, it's one way to look at it. I mean, the other way you could look at it is to go a little more narrow and just look at the top 2 holdings in the index right now, Apple, Microsoft. And, those 2 giants kind of account for about 14% of the total value of the S&P 500 right now. If you were to go back and try and find a time where the top 2 holdings in the S&P 500 were even close to that percentage, that 14% or so, you have to go back to the late 1970s, a time when IBM and AT&T were not quite at 14, but, mid 13% or so. So, I think one, that goes to show there can be some cyclicality to concentration. And that's a conversation we're having with clients now, but also, any way you want to look at it, I think it's fair to say that the index is extremely concentrated right now. And that's particularly true for domestic, large capitalization weighted indices.
Very interesting numbers for sure. So concentration is a big concern for investors, and that is why we have seen probably that investors have been pouring a lot of money into RSP. It has gathered more than 8.6 billion in assets last I checked in 2023. So tell us a little bit more why investors should consider RSP now. Overconcentration of cap-weighted indexes is one of the biggest reasons. And then you alluded to valuations too. The cap-weighted, market cap-weighted S&P 500 index has a forward PE of almost 20 now. So it does look a little bit expensive. And as you mentioned that even the equal weighted is not exactly a value index, but it is more attractively valued than the cap weighted one. Are there any other reasons why investors should consider RSP? Is it also because of its higher exposure to cyclical and more traditional sectors of the economy?
It's a good question, and I think it's probably all of the above. I'll say when we get this question, it is often in the context of comparing a potential RSP allocation to something like the S&P 500. That's a fair way to think about what's my benefit for RSP, because frankly, based on a lot of the conversations I have with clients, a lot of clients are doing just that. And so, in thinking about that, I'd say there's a bit of timeliness to why an investor would consider RSP, and there's the longer term investment rationale. Obviously, the longer term investment rationale that speaks to some of our previous comments about RSP's rebalance methodology, its factor exposure, its outperformance since inception. To the more timely standpoint of why an investor might want to consider an allocation to RSP right now, I think certainly it comes down to concentration. That's a big one. I think relative valuation is certainly top of mind as well, and I think the other one is just how RSP can help kind of provide diversification without taking on a significant amount of tracking error. But to help build a more durable, resilient portfolio for our clients. So, concentration, we talked about that. It's quite elevated. I think we're having a lot of conversations about how RSP is just going to pull you maybe away from some exposures that you might already have in your large growth name. From a valuation perspective, I could put some numbers on that. RSP appears relatively attractive compared to the S&P 500. If you looked over the last 20 years, I think this surprises some people because the valuation gap right now is fairly large. But if you looked at the average forward price to earnings ratio over the last 20 years since inception of RSP and the S&P 500, they're virtually identical, right? So, and this is based on forward analyst estimates of the underlying stocks of the portfolio. But over 20 years since inception, RSP and the S&P 500 have both averaged about an 18.6 forward 12-month price to earnings ratio. Right now, RSP's forward price to earnings ratio sits about in line with the long-term average, about 16.9. I looked the other day. So, just slightly above its average. But to your point, the S&P 500 is trading at about a 20% premium to that. It's forward price earnings is a little over 20 right now. So, and that's obviously due to the valuation expansion of those larger names that ran so well in the first half of the year. So I think investors have certainly taken note of that. And, as well as you can look at current valuations to be a predictor of future returns, they're taking note of that. And then, the other thing I would say is investors look to RSP for added diversification because of that exposure to the mega cap names that, as I said, they may already have. We talked about Qs at the beginning of this podcast. Many investors have exposure to that mega seven name. They want exposure to that mega seven name, but they want that exposure within the large growth segment of their portfolio. They don't maybe necessarily want to be doubling down on it within the core or the blend of their portfolios. So, with something like the S&P 500, after the run some of those names had in the first 6 months of the year, the first 5 months of the year, they may be looking to do some rebalancing, and they may be looking to trim some of that exposure to those names, particularly within, again, that core or blend segment of the portfolio. And so, that's also a place where we're seeing RSP can maybe naturally be a little bit better of a core, kind of pull them back to the left side of that large blend category, and why investors are considering RSP now,
So tell us how RSP should be used in a portfolio. Does it replace the core, or should it be in addition to core market cap weighted exposure?
It's a good question. And I would say most of the conversations that we have with clients, we observe our clients using RSP to supplement, replace. I mean, whatever percentages, an individual would assign to that. We do, I would say, primarily see RSP being a supplement or replacement to some market cap weighted investments. Again, kind of to pull the core back away from growth a little bit, reduce some of the overlap to something like the Qs, given that they still want the Qs, but it's still in the growth portion of their portfolio. And then maybe the other place I would see investors use RSP is kind of a replacement for underperforming active strategy. So, I think many know by now that it's been very difficult for active managers to outperform the S&P 500 over time. S&P has, and Nina, you're very familiar with this, some really great research on this within their SPIVA scorecards, looking at the win rates over time. And obviously, as I noted, it's been very difficult for active managers to outperform the S&P over time. As we both noted earlier, RSP has been able to outperform the S&P over time, and so that just goes to say that RSP has over time outperformed most active managers. Now, the S&P SPIVA reports look at the underlying index that RSP seeks to track, not RSP, but it looks at the S&P 500 equal weight index. But they show that over the last 20 years, the S&P 500 equal weight index has outperformed 99+% of active strategies. So, that's another place I think we see people using RSP is taking on a little bit of active share, viewing it with a little bit more active share, and maybe replacing some underperforming active strategies.
That's quite helpful. So RSP is not the only equal-weighted ETF that Invesco offers. You also offer many equal-weighted sector ETFs, and recently you rebranded the suite of these equal-weighted sector ETFs. They underwent ticker changes. So tell us a little bit about these changes.
We've talked quite a bit about RSP and all the benefits of equal weighting the S&P 500 index. I would say, but many of those benefits are applicable to the sector level. So if you're thinking about concentration, if you look at just the top 5 holdings, not the top 10 holdings, but just the top 5 holdings in any given S&P 500 sector, the percentage in those top 5 holdings often dwarfs even that of the top 10 holdings in the S&P 500. So if you look at sectors like communication services or information technology, communication, consumer discretionary, there you're going to see that the top 5 holdings in those sectors right now and often make up 60, 70, maybe 75% of total exposure in that sector. And if you just want to pick on technology because, it's home to the 2 biggest companies, right? Apple, Microsoft. Despite there being 65 companies in the S&P 500 technology sector, those top 5 holdings make up about 65% of the total exposure. So, outside of those top 5, investors are basically only getting 35% exposure to 60 of those 65 companies. And again, they're probably already fairly exposed to many of those large companies because of their weight in other indices. And so, equal weighting within a sectors is a simple, easy way to get broad exposure to that sector. I mentioned valuations earlier with RSP, from a valuation perspective as well. If you look in just about every case, every S&P 500 sector, you'll find that there are cheaper valuations in the equal weight version than in the cap weighted version. And so we do offer the equal weighted sectors. We do offer equal weighted exposure to all of the S&P 500 sectors. And we did recently undergo a bit of a rebranding campaign that just changed the tickers on those ETFs to more closely align with RSP. And obviously given RSP size and its market acceptance. And I think it just helps to simplify, make it a little easier for many of our existing clients, RSP customers, to identify the equal weight sector product, because the new tickers are a little more intuitive. So for each of those equal weighted sector ETF tickers, all of them now start with RSP. And then the fourth letter within that ticker is just something corresponding to the sector. So for example, the equal weight technology ETF ticker now is RSPT, or the equal weight communication services ETF ticker now is RSPC. So hopefully it makes it a little bit more intuitive for some of our investors.
Definitely very easy to remember now. And a lot of these sector ETFs make a lot of sense to me. You talked about over-concentration of top 5, top 10 stocks. I looked at the exposure to just 2 companies in some of these sector ETFs, the spider sector ETFs. So in the communication services sector ETF, XLC, just the 2 companies, Alphabet and Meta, account for more than 50% of the portfolio. In the technology ETF, XLK, Microsoft and Apple account for more than 45%. And then in the consumer discretionary ETF, spider ETF, XLY, Amazon and Tesla more than 40%. Energy ETF, XLE, Exxon and Chevron more than 40% of the portfolio. So yes, equal weighting makes a lot of sense in these particular sectors. Is there any other reason why investors should be using these equal weighted RSP sector ETFs in their portfolios?
Yeah, and I appreciate you bringing up those statistics. They're pretty eye-popping. And the good thing is, between some of those capitalization weighted spider products or Invesco's equally weighted products, they have I think it's worth noting, they have the exact same holdings in there. They're just weighted differently. If there's 65 holdings within the technology sector, you can cap weight them or you can equal weight them. So I think it's great for investors to have different options. And if you want more exposure to those names, you've got the cap weighted, or if you just want more broad exposure and you don't really want to pick the winners or losers, maybe the equal weight makes a lot of sense. So I appreciate you bringing that up. I think, many of the use cases with the equal weight sector ETFs are similar to the use cases of other sector or industry products. Just, obviously with the difference being the equal weight investor wants more broad exposure to the prospects of a sector or the sector they like. They don't necessarily want to pick the individual winners with the sector, or they don't necessarily want exposure that great to the figures that you just referenced, Nina. And so equal weight can spread that out a little bit. So, or as you see with sector investors, whether they're using that for a sector rotation strategy, or some investors we talk with just like to build out their portfolios with sectors being maybe more satellite positions to attempt to take advantage of something, a tactical macro trend. Equal weight investing tends to work well in those cases. But again, I would say mostly it's generally the same as we see with other sector investments. It's just whether or not, how much exposure do you want to those top names in those sectors you referenced, Nina?
Could you talk a little bit about the costs? Because equal weighting means higher transaction costs because the index and the funds have to be balanced more frequently. So basically, the market cap weighted exposure to the S&P 500 index through ETFs is now available at a ultra low expense ratio of just 2 basis points. And even the sector ETFs are very, very cheap. So could you talk a little bit about the slightly higher costs involved with equal weighting?
Yeah, so the annual expense ratio for the equal weighted sector ETFs are 0.4% a year, 40 basis points a year. It is a little bit more than you'll see with capitalization weighted, but to your point, there is a little bit more involved in the quarterly rebalances. And, I always say with investors, it is a very different exposure between capitalization weighted and equal weighting. And so for the investors that want that and desire that equal weighted exposure, they don't want to put all their eggs in maybe the basket of just a few larger names. Likely the performance is going to be fairly different between these two because they'll be driven by different names. And so over time, that difference in expense ratio, is likely to be made up in performance. Now, whether that's, positive or negative, you'd have to see. But, I would say it's a fairly competitive price. It's a little bit more involved of a product. And, again, with the difference in, certainly you get the desired sector exposure, but the overlap is fairly small between the two. And so again, if you have that desire to move away from those large products, I don't know that the difference in expense ratio would ultimately be what drives the difference in return. If you look over time, it typically is the desired exposure and the differences in the exposure that will most likely be doing that.
Great points. And there's definitely a reason to consider these equal weighted ETFs and hold them in the portfolios. Chris and Paul, thank you again for joining us today and for the excellent discussion.
Thank you, Nina. It was fun.
Thank you very much, Nina.
Thanks for listening. Let's quickly recap some of the tickers that we discussed today. So QQQ, as everyone knows, is the ultra popular ETF, and the cheaper version is QQQM. And the equal weighted S&P 500 ETF is RSP. And if you want to look at some of the sector equal weighted ETFs where there's a lot of concentration, then RSPT for the technology sector and RSPC for the communication services sector. Thanks again for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.